Welcome back. Now we welcome to the show our financial analyst, Sean Dempsey. Sean, what do you have for us?
Thanks, Bradley. A lot of stuff has been going on in the stock market this week. A lot of news has been brewing, I should say. And three stocks that I want to highlight are Disney, Google, and McDonald's. Let's start where the dreams come true, which is Disney. The company announced a plan to lay off 7,000 employees, restructure the company, and cut $5.5 billion in costs on Wednesday. This took place during its first quarter earnings call. CNBC market analyst Jim Cramer applauded Bob Iger for pushing to reinstate Disney's dividend by the end of 2023. He says it is a huge sign of confidence from management. The company suspended the dividend in early 2020 due to the COVID pandemic. The stock is now up about 27% year to date. And now, as you can see here on the stock chart of Disney for the past month, the stock has rallied 10% since January 19th. And this is mostly because of the overall market rallying and families traveling to Disneyland and Disney World over winter break. Now, another stock that has been in the news lately is tech giant Alphabet. The company lost $100 billion in market value on Wednesday after its new artificial intelligence technology produced a factual error in its first demo. Meanwhile, shares for Google's rival Microsoft rose by 3%. Microsoft announced this week that it would incorporate ChatGPT into products like its Bing search engine. It's going to take some time before investors know who's winning the AI game between Microsoft and Alphabet, but it's been clear over the past 2 days that Alphabet has a lot further to go to convince investors that it's on the right track. Now, as you can see here from Microsoft's stock chart, it's been doing well. It peaked at about $108 per share, but has since dropped 12% because of the news that was announced this past week related to AI growth in AI technology. And finally, we will wrap things up with everyone's favorite fast food chain, McDonald's. The Golden Arches are benefiting from inflation and rising food prices. Their competitors, Chipotle and other restaurants of that nature, are having a hard time attracting customers. However, McDonald's has now become the cheaper alternative option. The fast food giant said United States same-store sales climbed 10.3%, helped in part by low-income consumers returning more frequently. Executives also credited the success of its adult Happy Meal promotion and the annual return of the McRib for its strong sales growth. Now, for McDonald's stock chart, it has been doing very good as of late. No strong positive or negative move, but that's because the stock jumped 21% in October. And like I said before, this is because of consumer sales and people choosing to eat a lot cheaper than going out and being expensive and going to different restaurants. Now, in October, it was seen that the stock had a big jump, but because of the rise in inflation, people started to eat cheaper. Bradley, Tegan.
Yeah, so I mean, talking about these, people wanting to eat cheaper, we've seen in other times of economic down times and hard times that people turn to fast food over these more so fast casual food places that we also see in the market.
Right. I mean, we could see that this week with McDonald's and Chipotle actually announcing their earnings. They took a dip, so that really shows you where people are going.
Yeah, I mean, Chipotle raised their food prices and people saw that in their wallets, but with McDonald's, it seems that because it's fast food, people are just more willing to go grab food and leave, while Chipotle, you have to walk in the store and it's this sort of experience.
Right, well, I just mentioned a second ago this difference between fast food and this casual fast food. So fast food, McDonald's, Burger King, Chick-fil-A, all those types of places, whereas these fast casual places are, Chili's, Red Lobster, all of these. And actually, Chili's traffic fell 7.6% this quarter because of these fast food chains, taking in the customers.
Right, they're taking some of that market share.
They are taking some of that market share. You're right, Bradley. And I think that really shows with consumers not choosing to go out to some of these high-end restaurants, and not even high-end restaurants, just restaurants in general, opting more to go to Burger King and McDonald's and not spend as much money because they're thinking with their wallet.
Yeah, and I mean, you look at the consumer price index. I mean, prices are still up. Consumers are still spending less. Inflation's still up. Wages aren't keeping up with inflation. So people looking for a cheap meal, McDonald's up 10%. I mean, that makes a lot of sense.
Yeah, I mean, we had Luke talk earlier and Jacob as well talk about basically the jobs, these lower job rates, but we still have, people struggling, inflation, all of these different aspects. I mean, Sean, do you think that we're going to kind of continue to see these fast food places stocks continue to rise, or do you think it's going to change anytime soon with these, differing inflation numbers?
That's a great question. I would say over probably the next 3 to 4 months, you'll see those stocks continue to go up, but as inflation trends downward, you're going to see those stocks start to fall. fall and people start to go to high-end restaurants once again.
Sean Dempsey, Sean, thank you. One more question: Eagles or Chiefs tonight?
I'm taking the Eagles, Bradley. I don't know about
That's
you.
a good choice.
I'm
That's a
going
good
Kansas
choice.
City. I'm going Kansas City. That's all.